Good, good morning or good afternoon, depending on where you are residing currently. Welcome to our webinar today for Motels to Apartments. And my name is Blaine Wright. I'm the acquisitions executive for Motels to Apartments. We are a company that takes hospitality assets and converts them into flexible living options. And so just hopping on today just to talk about who we are and what we're doing and what we're about and where we're looking. So we've been in business for about almost 5 years now, on our fourth project, mainly projects in Arizona and in Texas, specifically South Texas, Rio Grande Valley area. And so we're trying to navigate a ever-changing market in regards to interest rates and different things. And so just wanted to talk about what we're doing and also what we're looking for. So if you're a broker agent in the hospitality commercial space, maybe you're a hotel owner that's maybe trying to decide whether you want to sell your asset or not. Maybe we might be a fit for someone that could purchase your property. So just wanted to welcome everybody. If you look at the top of our screen here, that my phone number is there. Info to motelsapartments.com, motelsapartments.com. Also, we have a subsidiary or company that brand that we're developing called Park Rise. So if you go to motelsapartments.com, you will see our brand that we're developing, or flexible living brand that we're developing right now. So just wanted to go over our buy box and kind of where we're looking and why we're looking there. So major MSAs. So right now with the way the economy is and the way things are trending, we want to be in major MSAs. So and we want to be in Sunbelt states. That's what we're familiar with. I'm actually based in Phoenix, Arizona, and our other one of the co-founders of the company is also based in Phoenix. We've done actually a lot of deals together in various different real estate sectors. And so we're familiar with the Sunbelt states. Also, population trends. People are moving to the Sunbelt states. The Sunbelt states typically are a little bit better for jobs, a little bit better for taxes and keeping your money, more opportunities, etc. So these are the areas we're looking for. So Dallas or Texas area. So Dallas, Houston, San Antonio, Austin. I did say the Rio Grande Valley, so that's like the Brownsville, McAllen area. We're actually doing an 85 unit project down there right now. Just completed a 30 unit at the beginning of this year. So comfortable in Texas. Phoenix, Tempe, Chandler, Scottsdale, those are all Phoenix metro area. Charlotte and Raleigh, North Carolina. Nashville, Tennessee, and then Florida, Miami, Orlando, Fort Lauderdale, Tampa, Jacksonville, and then Columbia and Greenville, South Carolina, along with Charleston, South Carolina. Charleston's kind of an up and coming, but if there's an opportunity there, we wouldn't shy away from that. So let's kind of go over what kind of asset we're looking for right now. So 1980s or newer, and the reason for that, asbestos remediation, also plumbing and electrical upgrades, possible lead-based paint. I'm not super worried about that, but that is something that's out there depending on how the condition. And so we want to try to avoid that. It just raises the cost exponentially. You've got to get special permits for the remediation for the asbestos. And it's a time factor and an expense factor. So that's why we're looking for 1980s and newer. Now, with that being said, will we look at something older than that? Yes. but the deal would have to be, really up our we're a really good deal for us to consider that, just because with asbestos remediation, I mean, you can take 20% right off the top for that, depending on the amount of units. So speaking of units, total room count, we want about 100 rooms. We'll look at sub 100, but typically the cost for doing 100 rooms versus doing like 80 to 85 rooms, that cost us almost the same. So we want as many units as possible. More units, more money on the back end. So it's a pretty simple equation there. Size of rooms. So obviously hospitality assets come in various different shapes and sizes. We really need 250 square feet minimum. If it's smaller than 250 square feet, it's really not going to work, because we're adding kitchenettes, in some kitchenettes, sinks, refrigerator, microwave, cabinetry, that sort of thing. And if it's not bigger than 250 square feet, it's just not going to fit. It's just the reality of it. So ideally, in a perfect world, we want, 350, 400 square feet is actually like home run, right in our wheelhouse. That's what we would prefer. Room type, we definitely want an extended stay type with a kitchenette. And the reason for that is, if the kitchenette's already there, that means the electrical's there. That means the plumbing's there. That means we're just doing a cosmetic upgrade. So we're just putting cosmetic things in, and that allows us to rehab the property faster, and it also lowers our costs. So definitely much preferred. And many amenities, we are flexible, but obviously if we're doing what we call a flexible stay, where somebody might be there for a week, and there might be somebody there for a month, there might be somebody there for 3 months, 6 months, 9 months. So we want to be able to have some amenities to offer them, especially Sunbelt states. We want a pool, a laundry facility of some sort. Also, maybe some flex space for like office or workspace, or meeting space. And then obviously maybe some type of workout facility, gym, would be preferred. Building height, obviously with that, we want to, probably be the max would probably be 3 to 4 stories. Anything taller than that, you're probably going to be in a super urban area, like a downtown area. And once you get into that, it's a very different ball of wax when you're dealing with municipalities, cities, and things of that nature. So that's ideally what we're looking for. And then we also want to look for the independent hotel. We love working with the independent hotelier. That is, where we've done our best, is when we acquire independent hotel assets. Not that we wouldn't look at anything that's flagged. Like we've done we've done we've done Studio 6 before in Arizona, and it's doable, but it can, with the liquidated damages, can be problemsome, and then we have to negotiate that. And sometimes the liquidated damages can be north of $500,000, and so it can really disrupt the deal if we are caught having to do liquidated damages. So just something to keep in mind. Market attraction. So 1 to 3 miles of major assets such as hospitals, universities, shopping, retail, medical facilities, industrial type buildings, business complexes, public transportation. That's a big plus, because there's going to be a good section of the people that are going to be wanting to stay in our properties that may not have transportation and might need that. So if it's close by, it's definitely a plus. And then we're also always looking for the major retailers: Costco, Target, Walmart. If they're nearby, that's definitely an area we want to be in, because that just means traffic, that means people. And so that means, they need housing. So current occupancy, we're flexible. Obviously, we're probably not going to get an asset that is just crushing it financially, making tons of money. More than likely, we're going to acquire something that needs help. And whether that's financial help, or whether that's physical help, physical rundown, or maybe we've got a tired owner that's been an owner for 25 years and wants to get out of it. There's lots of different situations. So how it's performing currently is not a major factor. We're flexible. We will get some into consideration depending on the asset, but we kind of know what we're walking into. We're looking for an add value situation with a hospitality asset. Acquisition. So when we acquire our properties, the best way for us to go right now is to do something creative, whether that's a seller financing, whether that's a wrap, whether that's taking over payments. You know, various different scenarios that I could list here. And the reason for that is because interest rates are so high, especially on just an acquisition. It's high, and then if we had to also get funds for major renovations, that's even more higher percentage rates, north of 10 to 12%. So money's very expensive right now, and so if we can acquire something that doesn't require that, it's definitely a plus in our book. Now, are we against bank financing? No, we are not. But the deal would have to really be a good deal, and it would really have to have a lot of upside for us to consider bank financing at this point, just because of the way rates are. So, again, we're excited about what we're doing. We're working on a deal in Brownsville, Texas. That's probably about 60% done at this point. So we're hoping to have that wrapped up, hopefully beginning of next year. And Brownsville's 85 units. So again, when in doubt, send the deal, and feel free to email us with your deals, and we'll try to give you feedback and whatnot of what we're looking for. And so if you have any questions, reach out. Hope everyone has a wonderful day, and we'll talk soon.